We mentioned it earlier. Crude oil futures are up again following a two-day decline. That's after a new report showed U.S. gasoline stockpiles tightened ahead of the summer driving season. The American Petroleum Institute reported inventories of gasoline dropped by 4.22 million barrels last week. We get official government figures at 10:30 this morning. Here to discuss the current state of the energy market is the Energy Word founder, Daniel Dicker. Dan, it's great to see you. Thanks for joining us this morning. We've been watching this issue very closely, the issue of inventories and refining capacity and how quickly refiners can make enough gasoline to meet with demand. What's your assessment of the situation?
You know, refining is a very, very interesting piece of the energy puzzle, Julie. We haven't had a major refinery built in this country in 60 years. It's always been a very up and down business. It's not like oil. Oil goes up, oil goes down. You make money when oil goes up. You lose money when oil goes down. If you're a producer of oil, if you're a refiner of oil, you're looking for a margin. It's a margin business. You take crude oil and you turn it into products. You turn it into diesel. You turn it into heating oil. You turn it into gasoline. You turn it into jet fuel. You turn it into all sorts of things. And those margins change not too much. They're really thin margins, usually somewhere around $2 to $5 a barrel between the products and the crude itself. Now, in bad times, refineries are just terrible. You know, I can recall something like Valero, you know, trading in the teens. Now it's trading, I think, $140 to $125, a share. So it's not the kind of business that drives new investment in it. So the old investment is there trying to make up, you know, in a moment when there's absolutely, zero supply, and they're running as fast as they can, and they're keeping these refineries together with, duct tape and baling wire. And the prices for gasoline and diesel, even, when you look at $110 barrel crude, is just sky high. It's basically pricing as if crude oil was closer to $200 a barrel. And that's just a function of, the refining business and how far behind they are and how they really can't catch up at this moment.
Well, Dan, always great to see you here. Talking about sticking with gasoline, there's a JP Morgan report calling for $6 per gallon gasoline, and they're saying a major driver in these counter-seasonal draws is gasoline is higher than normal exports. And I just read that Saudi Arabia, OPEC Plus, failed to meet their output quota by 2.7 million barrels last month. Is OPEC doing this on purpose? Are there serious shortfalls in the world in terms of drilling? Why exactly would some of these members not want to pump more?
Well, that's a deep question, Jared. Let's see how far we can go into this in the time allotted. I mean, look, there's been at least on paper, there's been a commitment from OPEC to increase production. But as you just pointed out, in terms of actual increases of production, they're less than thrilled to put oil back into the marketplace right now. I mean, let's be honest. They have looked at 5-6 years of very, very bad times. We saw oil prices that were negative during 2020, at least for a day. And this uptick in oil prices is a boon for these countries and for U.S. oil producers as well, who've suffered with negative returns for 5 or 6 years. So they're not particularly, thrilled to add a ton of balance the market at a time when they're finally making back some of the money they lost for 5 or 6 years. Now, we can discuss the morality of this, but you're absolutely right. The ability of many of these producers to increase production is in fact limited, but also their will to increase production is equally limited. So make of that what you will.
Dan, we've got to leave it there today, but we will definitely catch up with you again soon. The Energy Word founder, Daniel Dicker, appreciate your time here this morning.